Hello and welcome to the Tuesday Tidbit. Today's Tuesday Tidbit is what is a shared appreciation loan? So, shared appreciation loans usually are loans that your employer may have available to you. Very few employers do. It definitely is a perk of having certain employers. In Colorado, University of Colorado, CU Boulder, CU Denver, they have a shared appreciation program. Okay. So with shared appreciation programs, and certainly it's not limited to CU Boulder, a lot of employers can have it. What happens is the employer will lend you money for the purpose of a down payment on a house. Typically, what happens is whatever percentage they've contributed to you, whatever the amount they loaned to you, if they loaned 15% of the down payment to you, they would then receive 15% of the appreciated value when you go to sell that house in the future. Okay. So it's a way to help out employees get into houses, get into more affordable houses, because that loan, that shared appreciation loan, is not going to have any payments associated with typically. Typically, no payments are due. You will pay at the end when you go to sell that house, when you go to refinance down the line potentially. Whatever percentage they gave you, they will receive that percentage in return. Okay. So if they contributed 15% of your loan to value as a down payment, they would receive 15% of the appreciation, their money back plus 15% of the appreciation. As a consumer, it's a good way to hedge against an uncertain market. And that's why a lot of employers will do it to attract talent. Like, look, you don't know so much about Colorado. Come out to Colorado. We will give you some money for the down payment, and we will also get a share of the increase in your house when you go to sell the house down the line. But since you're not familiar with this area, and we're willing to bet on the market. You may not be willing to. We can help out with that. So it's a way for a consumer to kind of mitigate risk in a foreign area if they're not familiar with the market. For the employer, it's a way to attract talent, secure talent, and get their employees into more affordable homes since those loans do not have a loan typically. If values go down, yeah, that's kind of an advantage to you in this situation. This is like the one instance where decreasing values may not be the worst thing. It does reduce how much that employer can receive as a return in the future. Okay, they may be limited to only getting their money back instead of a share of the appreciation. Very interesting topic, kind of a rarity. We don't see a lot of employers participate in this kind of program, but few do. If you ever hear your employer say, hey, we have access to shared appreciation loans, certainly it has to do with this, and it's worth inquiring about the details. Thanks so much. Talk to you next time. Bye.